Welcome to Steward Wealth's December quarter markets overview. I'm Anthony Picone, Director of Steward Wealth, and joining me as usual is my fellow director, James Weir, to talk about what's been going on in financial markets over the December quarter so far. James, very eventful quarter, with Trump coming in. So everything seems to have flowed on from his election win.
Yeah, the politics was very much the dominant feature in this quarter. Obviously, the big one was Trump's re-election as US president. We've had the French Parliament, no confidence motion in Germany as well. So the two powerhouses of Europe. We had a coup in Syria, and of course the wars, serious developments in Russia, in the Ukraine war with missiles going into Russia and in the Middle East. So a lot going on.
So a lot of people were talking about the Trump bump. Markets really running quite strongly, bringing in a new bull market through a whole lot of different asset classes, including Picone.
Yeah.
Is there a risk that it's been overdone?
Yeah, it's a good question. It's been sort of nicknamed the bull market and everything. There are a bunch of sentiment indicators in the United States that are indicating sentiment is getting to an extreme. So we've seen things like the foreign investment going into the United States. In September, it hit an all-time high, and not by just a little bit. It was like a 60% jump over what we saw in 2021. There's another survey, US consumer confidence in the share market reached an all-time high since the survey began in the 80s. The American Association of Independent Investors, they do a bullish-bearish survey. That's back to 2005 levels. Even the professional fund managers are getting in on the act. Their cash levels are about half of their long-term average, so they're all but fully invested, and their weightings to American equities have just been, in the latest survey, they're at an all-time high. So, yeah, things look pretty stretched.
So, James, global markets performance has been led by US equities again, the great wealth creator. Steward Wealth's been overweight for quite some time in US equities. Do you see any changes to that position?
Certainly in our December investment committee meeting, we decided not to change any of the asset allocation weightings. So we remain overweight to the United States. And that is reflecting really that the US economy has been by far the best performer out of the OECD. We've been banging on for some time that the level of fiscal stimulus going into the US economy is really quite high. They're running deficits approaching 7% of GDP. So that's about $2 trillion that's coming from the government being injected into the economy. And a lot of it is also going into things like manufacturing, construction spending, and capital expenditure. So the US economy is really firing compared to any of its international peers. Now, of course, the economy doesn't equal the share market, vice versa, but the market has been driven by very, very strong earnings forecasts. At the moment, the US forecast for next year is about 11%. That compares to Australia at around sort of anywhere between potentially 3 to 5%. But those mega cap tech stocks forecast earnings growth there is over 20%. So we feel that the momentum that has been driving those for some time, we don't see necessarily why that should stop. Obviously, there is some level of uncertainty about what happens when Trump takes over in January. I don't think anybody on the planet can tell you what's going to happen there. So we are disinclined to reduce weighting on a guess as to what might happen. So we remain overweight US equities.
So given that we're overweight US, we've been somewhat underweight Australian equities. Earnings just haven't been as strong. Can you talk us through that, James?
Yeah, that's exactly right. For some time, Australian earnings have lagged US earnings growth, and that's really is what underpins long-term share market performance. We got another set of GDP figures through the quarter for Australia, and again, it was a disappointing set of numbers. 8 out of the last 9 quarters have seen GDP per capita go backwards. The only reason we get positive growth is from increased population, so the pie is getting ever so slightly bigger, but everybody's slice is getting ever so slightly smaller. it's reflected in Australia's household disposable income has been the worst performing in the OECD since COVID. And that's really a function of very high house prices, people having to borrow very large amounts of money to buy a house, so dedicating huge proportions of their income to servicing those loans. The upshot is that Australian earnings are very anemic compared to the United States. One of the other things that does concern us is that the Australian market, which has performed remarkably well this year, but a lot of it has come from the banks, which account for about a quarter of our market. Bank PEs are currently trading at about double their 25-year average. And there is not an analyst out there that can really give you a good explanation of why. So we just are concerned that that level of valuation, Australian banks are now the most expensive in the developed world. So we are concerned that the impact that a revaluation of the bank sector might have on Australian equities. So we're comfortable remaining underweight.
Okay, great. Oh, well, I suppose it's watch this space for 2025.
It promises to be a very interesting year in many ways, as it always is.
Yeah. Look, that wraps up the year from us. It's been a great 12 months. The directors from Steward Wealth, James Weir, Paul Griffer and myself, wish you all a safe and great new year. And we look forward to catching up again in 2025. Thank you.